So you got a lump sum of money and you're ready to invest it for the long term. You could jump all in at once with lump sum investing, or take it slower and phase it in gradually using dollar cost averaging. Each method has its pros and cons. After all, investing isn't all about crunching the numbers. Emotions play a huge role. The fear of a market drop right after you invest can be intense. But then again, waiting too long to invest means you could be missing out on potential gains. The trick is to find the balance. How do you juggle the risk of short-term market dips with the fear of missing out by delaying your plan too long? You know markets go up in the long run, so getting your money in sooner rather than later seems like that would be the obvious choice. But then some doubt sets in. And if the market drops right after you invest, you're probably not going to be very happy. Or what if it's been on a hot streak and things seem overvalued? I'm going to first break down a variety of studies around these strategies and take a look at what happens when the market feels overvalued. Do the conclusions from the studies still hold up? I'll also suggest how you can take this information and best match it to your personality and your own risk tolerance. And then towards the end, I'll give you my own personal recommendation that I tell my friends and family. I'll also take a look at an actual example comparing the two methods during the housing crisis. First, the basics. The biggest difference between dollar cost averaging and lump sum investing comes down to timing. When you dollar cost average, you spread out your investments over a period of time at regular intervals. Lump sum investing, on the other hand, means putting your available money all into the market at once. This display you're looking at shows what would happen if you invest $12,000 using lump sum investing versus dollar cost averaging. If you have a lump sum, you could invest it all at once in the first month, or you could spread it out evenly over 12 months, putting $1,000 per month in. This decision comes down to whether you're investing $12,000, $100,000, or even $1 million. Maybe you got a big inheritance, a big company bonus, sold some real estate, or received a life insurance payout, maybe even rolled an old 401k into a IRA, and now you have to decide how to invest it. No matter the situation, the question remains the same. Do you go all in at once or take it slow and spread it out? Vanguard conducted a study analyzing rolling 10-year investment periods comparing lump sum investing to 12-month dollar cost averaging. They looked at 1,021 different periods, and the results were pretty clear. Lump sum investing came out ahead about 2/3 of the time, and it didn't matter whether the portfolio was 100% stocks, a 60-40 stock bond split, or even 100% bonds. Lump sum still won 2/3 of the time. The pattern held true not just in the US, but also in the UK and Australia. Another study by Northwest Mutual also looked at 10-year returns and again compared investing lump sum immediately in the US markets versus spreading it out over 12 months. Their results showed that investing all at once outperformed dollar cost averaging at least 75% of the time, again, regardless of asset allocation. These results shouldn't be much of a surprise to us. After all, the market tends to go up most years. In fact, since 1950, the S&P 500 has been positive nearly 75% of the time, as shown in this chart. During positive years, it often means that spreading investments out over 12 months results in buying at higher prices along the way. I want to give a quick shout out to Nick Maggiulli because he's got some great data I'll be using from his site of dollarsandData.com. Check out this chart he put together comparing dollar cost averaging to lump sum investing using a 60-40 portfolio to see which would have the most money right after the buying period is over. He looked at every 12-month period from 1960 to 2018. So he started in January of 1960 and then looked at someone starting in February of 1960 and then March and so on. For the stock portion, he used the SP 500, and for the 40% bonds, he used 5-year U.S. Treasuries. Using this portfolio, Nick found that dollar cost averaging underperformed 80% of the time. That's depicted by when the graph is below the break-even line. However, there were times when dollar cost averaging beat lump sum investing, like during the market crashes of 1974, the early 2000s, 2008. Okay, that makes sense because dollar cost averaging allows you to buy into a falling market, which means you're getting stuff at a lower price. I'd like to take a quick moment here to say I'd really appreciate it if you could hit the like button, maybe think about subscribing, and leave some comments below. It really does help the algorithm and supports the channel. Okay, now let's look at the data another way. Here's a distribution of times the dollar cost averaging underperformed lump sum investing, along with the size of that underperformance. The most common amount of underperformance when using dollar cost averaging was around 5 to 10%, with an average sitting at right at 3.7%. Now, the studies I've highlighted all used a 12-month phase-in period. If you decide you're more comfortable phasing your money in, that's important not to go beyond 12 months. Otherwise, the chances of underperforming get even higher. Here's Nick's animated chart showing how often dollar cost averaging outperformed lump sum investing when the phase-in period varied. It starts with a 6-month phase-in, then 12 months, 18 months, and so on, all the way up to 60 months. As you can see, the longer you take to phase your money into your investment, the worse the outcome tends to be. Now, you might be wondering how all these studies change if you choose dollar cost averaging and keep your money waiting to be invested in a high-yield savings account or something similar, earning income at least. Well, JPMorgan did a pretty interesting study on this. They used the typical 60-40 portfolio, 60% U.S. stocks, 40% U.S. bonds, and compared lump sum investing with a phase-in of over 3 months, 6 months, and 12 months. They referred to these periods as tranches. A big difference here is that they assumed the excess cash waiting to be invested was held in 1 to 3 months treasury bills. Each bar in their chart represents a range from the 5th to the 95th percentile of observations, and the middle line shows the median return. The key takeaway is that as the phase-in period gets longer, both the median return and the range of possible returns start to shrink. They found that lump sum approach outperformed phasing in over 3 months 63% of the time, 66% of the time for 6 months, and 69% of the time for 12 months. However, the range of returns for lump sum strategy was widest, and this demonstrates the trade-off you face. A phased-in approach can narrow the range of possible returns to expect, but is likely going to lower the median return just a bit. Now, all these studies come to the same conclusion. Lump sum investing beats dollar cost averaging roughly about 2/3 of the time. But what they don't account for is how you're going to feel if the market drops right after you invest that lump sum. I hear it all the time. People know the studies, but then they hear talk about the market being overvalued, and suddenly they want to wait for a pullback. This has especially been true in recent years. So many so-called experts and major investment banks talk all the time about the market being overvalued and people expecting a correction. In fact, the New York Times reported that the consensus among so-called market experts and some of the largest asset managers was that the S&P 500 would gain 6.2% in 2023, and they followed that up by predicting that it would be up 3% in 2024. But what actually happened? The S&P 500 jumped 26% in 2023 and another 25% in 2024. Imagine if you were worried about valuations and you were waiting for that market correction. You would have missed out on all of those gains. This just goes to show it's best not to rely on the predictions of so-called experts. It's really interesting how investors think about this debate anyway. Let's say somebody already has all their money invested in the market and then volatility spikes or the market turns negative for a while. You know it's smarter to stay fully invested and ride it out rather than sell and guess the perfect time to get back in. So, when you do get your money fully invested, you're constantly making the decision to stay invested. You don't sell out and then slowly average back in every time you get nervous. Or at least I sure hope you don't do that. Worrying about a market drop is just part of investing. It's always there. The key is to think long term and not get caught up in short-term market swings. Most people hardly notice when the market steadily climbs, but they definitely pay attention when it drops. You're emotionally attached to your hard-earned money, and the fear of losing some of it often outweighs the excitement of making more. I've seen many investors celebrate their portfolio growing from 1 million to 1.5 million, only to panic when it drops to 1.3 million. And they completely forget that they're still up 300,000. Losses just feel more painful than gains feel rewarding. And that emotional weight can lead to costly mistakes. So the real question isn't just about which method gives you the best mathematical chance of coming out ahead. It's what you can stick with and sleep at night. The reality is, most mistakes investors make are emotional ones. If a sudden market drop is going to stress you out and keep you up at night, then using a hybrid approach might be the better option for you. At the end of the day, you can know all the stats, but there's no single right answer that perfectly matches your personality and risk tolerance. And no one can predict which strategy will work best in any one given year. Now, before I get into my own personal recommendations for friends and family, and take a look at what happened during the housing crisis, here's a few things to keep in mind. 1, if you use dollar cost averaging, it requires discipline to commit to a plan because it can also open the door for behavioral mistakes. Make a decision to buy at regular intervals, regardless of what the market is doing, and stick to it. 2, if you dollar cost average, don't spread it out longer than 12 months. Shorter is better. The studies show that the longer you go, the worse it gets. 3, if you dollar cost average, there's cash sitting waiting to be invested, and this can be tempting for some people. You must view that money as off limits. Don't spend any of it on wants you might want in life. Keep it in a high-yield savings account so it's at least earning some money. And 4, whichever method you choose, stick to it and don't look back and second guess yourself. After you've made the choice, try not to care about what the market is doing over the course of the next year. Feel comfortable knowing that several years from now, the market will be higher and you'll be very glad you made the investments you did. So, how do I answer this question for friends and family? I do take time to explain the key facts that we've already talked about, like how lump sum investing tends to win about 65 to 75% of the time. But I also get that emotions play a big role for people, and many people can't stomach the thought of a drop shortly after investing. That's why I suggest a middle-of-the-ground approach. Maybe put 50% in right away, then 25% in 3 months later, and 25% 3 months after that. In the end, it's got to be their decision though, and they should go with whatever feels right for them. Of course, in a really bad year, dollar cost averaging can come out ahead, even though lump sum usually wins. Take 2008, the worst year in the S&P 500 since 1931. It dropped 37%. That's a case where dollar cost averaging had a clear advantage. If you would have invested $10,000 in the S&P 500 at the start of 2008, lump sum investing would have grown into about $18,600 10 years later. If you would have invested 50%, then 25% in 3 months, and then the other 25% 3 months after that, it would have grown into $19,700. But spreading the investment out evenly over 12 months, the investment would have grown into $22,200. 2008 was one of the best years to try and showcase dollar cost averaging having an advantage, simply because of the massive market drop. That said, notice how the 50-25-25 split still landed somewhere in the middle, showing that the balanced approach can be a solid option. And even though this year had a huge drop in the market, the differences 10 years later may not be as big as you might have expected. I hope you found this video informative. Please hit the like button, leave some comments below, and thank you for watching.